Buy low, sell high. It's one of the most common phrases you'll hear about the stock market.
No. I said buy low and sell high. I don't want to hear it.
And it definitely makes sense, but personally, I don't actually abide by that rule. Instead, I go by the rule of buy high, sell higher. And in this video, I'm gonna explain why that is, and I'll also explain the one exception to that rule. So let's get into it. My name is Charlie, and on this channel I make videos about building wealth and achieving financial freedom so that you can free up your time to focus on the things that you truly care about. Now, in case you're not familiar with the criteria that I use to pick stocks for trading, one of the core requirements is that the stock has to be upward trending over both the last 3 months and the last 5 years. So based on that criteria alone, I basically never buy stocks that are falling in value, and there are a lot of reasons for that. The first being that in order to be successful in the stock market, you want to ride the trends that large institutional investors create. Because the market is actually dominated by these large institutions that buy stocks in $100,000 and $1 million increments, and not the smaller retail investors like you and me. So because of this, the momentum of stocks becomes a very strong force. Essentially, as soon as a company releases positive news or a positive earnings report, investors start buying into that stock, which of course pushes the stock price higher. And as the stock runs up, more and more institutions start pouring money into it because they want to take part in that growth too, so it creates sort of a domino effect that causes the stock to keep rising. So that's why usually when a company with solid fundamentals releases a positive earnings report, that stock then tends to gradually rise leading into the next earnings report. But of course, that momentum does work in both directions. So when a stock starts to fall more than say a few percentage points within a few days, it tends to keep falling pretty significantly and quickly before recovering back to a more gradual rise. And we can see this trend in all of the solid Dow stocks that I like, such as Apple, Microsoft, Nike, and Visa. And we see it even more clearly in stocks like Square, Netflix, and MasterCard, which aren't in the Dow and don't pay a dividend, so they tend to be more volatile. So you can see that if you were to buy a stock right when it starts falling, you may get it at a slight discount, but more often than not, it'll actually keep falling and take a while to recover back to where it was before. So it's actually a better opportunity most of the time to buy it when it starts to rise again. And the main reason for these steep drops is the automatic trades and stop loss orders set in place by these big institutional buyers. So essentially a stop loss order is just an automatic trade where you tell your broker to sell a stock once it drops below a certain price. And the goal of those orders is, just as the name implies, to prevent yourself from losing money on a trade. Because let's say you're up about 20% on a trade, you could then set a stop loss order to trigger once the stock drops 5%, and by doing that, you've locked in a minimum of a 15% gain on that trade. So a lot of institutions like to use these stop loss orders in order to protect their gains and avoid participating in huge drops in the market. But this again creates a huge domino effect because as a stock drops, those stop loss orders start to get triggered, and since they're all automatic trades, that sell-off can happen very quickly. And that's why we often see pretty big drops in a stock even without any news being announced. Because all it takes is for one or two big institutions to sell off some of their position, and all of a sudden these stop loss orders start getting triggered and create an even bigger drop in the stock price. So when you're selling covered calls, your main goal is really just to avoid those big drops. Because when the stock drops say 2 to 5% after you buy it, that's really nothing to be concerned about because you can still sell calls at or above your cost basis and bring in some great premiums. It's really only when your stock drops upwards of 10% or so that your premiums are significantly affected, and so that's the situation that you're trying to avoid. And as you've hopefully been able to see so far, buying stocks that are upward trending is a very effective way to avoid being in that situation. So for those of you that have seen my video about why I don't use the wheel strategy, this is probably the biggest reason, because when you're selling puts, you're forced to buy stocks only when they start falling, which means that you're entering a stock when it starts a negative trend, which is pretty much never a good idea. For stocks that you're trading, it's almost always best to enter the stock when it's in a strong upward trend so that you can continue to ride it upward as more and more institutional money pours into it and pushes the price even higher. So before I get into some examples of how I'm applying this in the market today, I just want to make it clear that these trends apply to pretty much every major stock in the market. Because I know there will be people thinking,
well, you're just cherry picking a few stocks. Of course you could say that in hindsight.
Which I really don't understand, because again, I'm just talking about the stocks that are best for trading and the stocks that I've personally been trading for a while and have had a lot of success with. And if you understand how trends in the market work, it's really not hard to pick these stocks that achieve consistent growth over time. But in case there's still any doubt, you can see these same trends in the major indices like the Dow Jones Industrial Average, S&P 500, and the NASDAQ 100, which of course are all extremely diversified, so these ideas are not predicated on the performance of a few particular stocks, as some people seem to think I'm trying to imply. So with all of that said, let me show you how I'd actually apply this methodology in the market today. And there's a few stocks I've got my eye on, all of which are upward trending over the last 5 years, but the 3-month charts don't look quite as good, so I'm just waiting for the stocks to recover a bit before I feel comfortable buying into them. And the first is Salesforce, which is ticker symbol CRM. So we can see that the 5-year chart looks great. The company has very consistently increasing revenue over time, and it was recently added to the Dow Jones Industrial Average. And for those of you that have been watching this channel for a while, you know that I like to trade Dow stocks whenever possible. So Salesforce has fallen a bit over the last few months, but not because of anything that's changed fundamentally with the company. Most likely, traders have just been taking some profits since the stock ran up so quickly after being added to the Dow back in August, and that profit taking started that sort of downward domino effect that I talked about earlier. So personally, I'm going to wait until I see about a 10 to 15% bounce off the bottom, which is my indication that the institutional money is pouring back into the stock, and it's safe to come back in and ride it up. And a similar story applies with Home Depot, which is another member of the Dow Jones Industrial Average with strong increasing revenue, and it is technically upward trending over the last 3 months, but there's been a lot of volatility along the way, and the 6-month chart is relatively neutral. So I'd like to see a stronger upward trend before I really consider entering back into it, and in this case I'll be waiting for about a 5 to 10% increase from where it is now. Then the last two stocks are Visa and MasterCard, both of which tend to behave very similarly, although Visa is a member of the Dow Jones Industrial Average and MasterCard isn't. But they're both very strongly upward trending over the last 5 years, and they generally show increasing top-line revenue every single year, with the exception of last year due to the pandemic. But I'd expect that their Q4 2020 revenues will be pretty strong once those are announced. And I think the payment processing industry is a great industry to be in right now, especially with the growing digital economy. So once I see that increase in revenue again and the 3-month chart starts to look a bit stronger, I'll be happy to jump back into both of those stocks. Now, I've mentioned that there is one exception to the buy high, sell higher methodology, and that exception is for my long-term holds. Because the whole idea behind this methodology is to avoid buying stocks that are likely going to drop in the short term, because those stocks aren't great for trading. But with stocks that you plan to hold for the long term, those short-term drops don't really matter, and it can often actually be good to buy stocks during a dip in order to get in at a better price. With that said though, I would never necessarily wait for a stock to dip before I buy in. If I want to buy a stock for the long term, I'll just buy it at the current price, because again, if it's a stock that I like fundamentally, I can feel confident that it'll rise long term, regardless of the current stock price. So now, if you haven't seen my video yet about how I actually pick great stocks for covered calls, be sure to click that video in the bottom right corner of the screen. Thanks for watching, and I'll talk to you all in that next video.